Well, welcome to yet another episode of Market Makers, and all the more important because the two key events that the whole market, globally as well as locally, were waiting for, the Fed decision and the RBI monetary action. Both of those are out of the way. So getting a very special guest to talk about what does the market do from here on until probably we hit the elections. So pretty much Outlook 2014. And to talk about that, Navneet Munot, Chief Investment Officer of SBI Mutual Fund, joins me on the show. Great having you, Navneet. Thanks for joining in. Are you happy or with whatever has happened from both the central bankers?
The US Federal Reserve announced their decision to taper the quantitative easing by $10 billion a month. At the same time, I think the statement is quite dovish, much more dovish than what markets would have thought. And they have given a very strong forward guidance of keeping rates close to 0%. Earlier it was that as and when the unemployment rate in US goes below 6.5%, they may start probably thinking of increasing rates. But now the goalpost has been changed to the inflation target, that till the time they see maybe a 2% or so inflation, till that time the rates will remain as low as close to zero as possible.
Right.
And that has probably soothed the nerves of the market, that markets were a little worried about in terms of the whole stance of the US Federal Reserve. My sense is that in next couple of quarters, I think the large part of the quantitative easing would be taken back. I mean, there would be more to come in terms of tapering. But I think the strong forward guidance is the personal view is that it's not very good. I mean, because the world is a dynamic. I mean, things may change dramatically next year, and then giving that I would say a strong guidance actually makes markets a lot more complacent, which we are seeing in the market. That US markets have risen much more than their earnings growth, and it's the P is getting expanded because if you keep the cost of equity lower by keeping interest rates lower, then you are basically expanding the multiple. So a large part of the future gains are getting front loaded. But over the last 6 months, our view has been that I think it was a kind of a ghost that got created, that once tapering happens and there is going to be outflows from all the risk assets, but it's unlikely to happen because Fed is not going to make that whole event very disruptive for the financial markets, because they know the impact it can have on the real economy as well, and the economy is not as strong that they can afford to make markets more disruptive, having seen what happened in May and June. Coming to RBI, our own expectations were that they would go for a 25 basis point rate hike, going by the stance that they have taken in last couple of months, that they were sounding a lot more hawkish earlier. But now they are saying that we need to take a more futuristic view and need to wait for more data points in terms of how inflation behaves. I don't know, so do I need to send my analyst to vegetable market and try to
figure out what the vegetable prices are?
Figure out where the CPI would be in January and how will RBI react to it. But another point, I think we need a slightly higher real rates for some time to probably restrain consumption and promote savings. Deposit growth has been at a multi-year low, barring the recent period where this $34 billion that came from FCNR and the banks tier 1 capital. Apart from that, still the savings are not rising. The cash with public has been rising for last several years. So probably we need to keep real rates elevated for a couple of months to incentivize savings and to probably restrain consumption, which will be good from the overall macroeconomic stability point of view.
Okay, so you believe that rates could stay high for the next couple of months at least, if not more. What does that do to how do we as a market perform? Because I think the next big trigger for our markets would be the elections. That is 6 months from now or 5 months from now. What do we do until then?
Yeah, so markets have already started discounting a certain outcome from the elections, and I think the state elections sent a very strong signal. It's increasingly becoming clear that the voters are looking for growth and governance. Inflation is a very big agenda as far as the voters are concerned. Also, the better growth and governance, I think that has probably is a very, very clear message, and I think all parties. So my sense is that in next election, the next government, in which whatever form, whatever structure it comes in, I think they will clearly realize that they need to deliver high growth and a better governance, and that completely changes the whole template of the economic policy, the way it has been pursued for last several years, particularly at the central level. And also I think inflation is could be such a big political point. I think they have becoming increasingly more pronounced, and I'm sure that, and there is a only a small part of the inflation that the government through right kind of policies can tackle, and I'm sure that the new government is going to put a lot more focus on that. Some of the fears
whichever
that
government it may be.
Whichever government it may be, and of course if it's a stronger government, I think the biggest push that can come is from a confidence on the investment cycle side, because whether it's the private capex that is completely stalled and also the large infrastructure projects, I think that can be given a big push. But even otherwise, I think the policies, particularly from the fiscal side, the whole populism has not worked very clearly, which is coming out from the state elections, and I'm sure that next government is going to pay more attention towards that we need better macroeconomic policies, a higher growth, which probably results in better political dividend as well.
A small barometer of what, if not the whole market, then what the rate sensitives or what the currency sensitives would do would be how the INR dollar equation shapes up. And I'm not asking you for forecasting, but your investments, you are basing them on what levels for the currency? Do you believe we can actually strengthen above the 60 mark, or do we stay between 62 to 64 for the next 5-6 months?
I think the extreme high volatility that we saw in currency in 2013 is unlikely to get repeated in 2014. I think with this $34 billion that RBI has given them a lot of cushion to handle any kind of crisis which might emerge induced by volatility anywhere else in the world, which can impact emerging market flows. In case that happens going forward, I think their ability to handle that they are in a far stronger position now. So our sense is that currency is likely to get stabilized in a very narrow band. My sense is that RBI is unlikely to allow appreciation of the currency in case flows get bunched up, because they would like to replenish the forex reserves that the bank has lost in last 5 years, and I think they would support the currency. I mean, they are likely to support dollar at, maybe I'm just guessing, I'm putting a number to, let's say 60-62 levels, where they would keep buying dollars from the market, which they have done recently, and at the higher end, I think probably at 65 or so, there is likely to be support. So I would expect next couple of months currency remaining in a very narrow range.
Having put the macro into perspective, now let's focus on what does an average investor do with the markets over the course of the next 6 months. We spoke of the currency. What do you do with the currency sensitives? Because the last couple of months, or probably the last 1 year, these are the ones which have performed really well. Be it technology, which has had a stellar run the last 12 months, or be it pharma, which has had a fantastic run the last couple of months. Let's talk about technology. What do you do here?
So most of the industries, you mentioned about the currency weakness, so wherever you have a cost structure in rupees and you have the revenues in dollars, of course they are going to be a beneficiary the way currency has depreciated, and they've also got a benefit from the demand environment which has improved, particularly given the growth in the US, and in case the capex cycle is getting revived, so obviously they have got they are the prime beneficiary. You need to keep in mind in terms of the valuation and try to pick the right stock within the sector where the growth expectations are getting valued and where you think that margin of safety is available.
Okay, so let's speak about each of these individually. Technology, large caps trading at 18-19 times, small caps, mid caps trading at between 12 to 15 times on an average basis. Is there value here? Because a lot of people compare consumption with technology and say that both of them defensives, consumption at 33-35, technology at 17-18. So there's a lot of room for technology to go. You believe in this argument?
Yeah, so maybe there could be some scope for looking at some of the mid caps where the valuation gap is there, and probably you can find some value there. But by and large, we are equal to marginally overweight on that sector.
Both large caps as well as mid caps. Yeah. But if you would
not as much into mid caps as of now, but yeah, I mean that's a space one needs to look at.
Okay, so mid cap technology is one. Pharma would be the other pocket, and I know you can't broad brush the whole space with one paint. But you know, what does one do here? Because there are multiple winners that have come the last couple of months.
Yeah, it's completely bottom up actually there. So it's very difficult to put a very, a macro view on pharma. I mean, people can talk about, the opportunity in US generics and the domestic formulations and all. But I think these are more bottom up ideas. So when you meet these companies, you like those stocks for the basic characteristics they have in terms of the return ratio they have, in terms of the growth potential they have, in terms of what could be the upside there, in terms of the management, the way they run the business. And in some of the companies, you really like the way they are innovating. So that it's kind of that at a bottom-up level, you like these companies, and obviously you end up getting overweight compared to the weight it has got in the sector.
Okay, so since we are talking about rates,
but I must mention one point, that it's one sector that is liked by almost every single investor, and then you always need to keep that fact in mind.
But it is a bottom-up story.
Yeah.
Okay. So then let's try and talk about spaces which can be painted with a common brush, again in the export sensitive pocket. And there are a couple of auto component companies, the larger ones, which have done very well, the likes of Motherson Sumi and a couple of others, which have had a good run, and they have a large export theme. And then there's a textile space, which a lot of people believe, because what's happening in Bangladesh and otherwise, would do well. One, the auto components or the auto story, wherein there is a large export component. You like the pocket?
Oh yeah, there are several quality names. You mentioned about some of them, and then our portfolios own several of them. So overall, I mean, again, I'll repeat that point, that I think a weaker currency is a boon for us. And also, I think a lot of these companies have gained competitiveness, have innovated a lot, have invested a lot in terms of their R&D and then the market reach, and they've really restructured their operations, are doing very well. And so the entire exports, in terms of whether it's engineering, it could be auto ancillaries, it could be a couple of other things. I think that's one area we are looking at very seriously.
I'm guessing that would include textiles as well. I mean, the reason I was bifurcating is because
that space, I mean, in terms of the quality names, I mean, which meets all the hygiene factors that we look at. I mean, the universe is little small, but otherwise, I think within the engineering and auto ancillary, there are a lot of names.
Okay. Having discussed the export-oriented theme, the other big pocket, which is a bit of a black box for most investors the last 12 to 24 months, is banking and what to do there. Sure enough, the easy ones would be to pick up an HDFC Bank and HDFC and just say that these companies will do well. But the question mark comes over PSUs, wherein there are 50% of the respondents who come on the channel say that they are very attractively priced at price to book, and the remaining 50% say that we don't know what the book is in the first place, so we can't place a value, and therefore we are avoiding that pack. What are you doing?
So far you said, I mean, the easier path, so we have taken that easier path. Okay. We have been with retail lenders, we have been with certain high quality names, and have been, I think, by and large underweight financials. One, that the view on the interest rates, also the margin compression that can happen, and then the larger issue is of the asset quality. That is still, I think, the stress is quite visible from the way economy has been. As the cyclical recovery takes place, I think next year, a lot of these assets, I think, may start producing better returns, and a lot of these assets which are completely non-performing today may be in a better shape going forward. But I think it's still a couple of quarters away, and you need to watch it very, very closely in terms of how how the whole economic cycle is shaping up, and how much more stress is left on the asset quality. So we are not giving that benefit of doubt that, okay, so everything is going to be rosy. I mean, overall we are very positive on the economy and the markets, but not giving that benefit of doubt, because the level of stress that we have seen in last couple of quarters or couple of years, I think it will still take some time for it to really work its way out. And the amount of leverage has got concentrated in few names, where there's extreme amount of high leverage. Their ability to sell assets and restructure their operations, where those projects can become viable, where those assets from the banking sector's perspective can become viable, is still to be seen. We keep hearing a lot that, okay, lots of these deals are going to take place where they would be able to sell off some of the assets, and the balance sheets will become a lot more, I would say, where they can probably survive. But it needs to be seen. And also, I think it has a slower economy also has an impact on a large part of the SMEs, other businesses, where you need to be a little careful. But again, I would repeat the point that yes, you are right, the valuations are cheap. You need to eye that. I mean, you need to keep looking for that space, and as and when you get a little more comfortable on the asset quality side, you need to look at that space.
Okay, just a small piece of advice to somebody who's listening to you right now, Navneet. There are multiple people who come in and say that one of the easier things to do in banking would be to buy some of the prospective bank license applicants, because should they get the bank license, then the story unfolds really well. These stocks tend to become multi-baggers. There are past experiences that some investors may have. What do you think? I mean, some of the takeover candidates or some of the people who applied for the bank licenses, would you play that theme? Would you buy some companies based on this theme?
They fall in the category of the special situations, and it's always very tricky actually. First of all, I mean, getting a banking license, and we have heard it from several prospective applicants also, it's not going to be, I don't think that you can just put it in a simplistic manner that they are going to be multi-baggers when you get the license. It's not a license to make easy money.
Easy money.
I mean, it's a license to, I mean, it comes with a lot of responsibility.
Sure.
I mean, it comes with a lot of, I would say, risk as well as hard work for several years. I mean, somebody who's been a wholesale lender to convert it into a retail franchise, it's not going to be easy. I mean, the way your liabilities and your assets have been managed, it's a very, very different format altogether. So there's going to be, you have to go through that learning curve. You have to go through that whole curve of transformation. So it's not going to be easy, and I'm not sure that we are playing that any of the names, in particularly in NBFC. If we have an NBFC, we like it for their business model, we like it for the return ratios that they are showing, we like it for the risk management practices that they have in place, but not that they will become bank and suddenly their profitability can go up, because for several names it's going to be very stressful. It's not going to be easy when you have to comply with the SLR and CRR and the priority sector lending and several other norms, and also the cost of putting the whole franchise.
A couple of other pockets, and one of them has been doing very, very well, the consumption theme. Now, be it pure play FMCG companies which are trading at maybe 30, 35 times, or be it some of those niche companies which might be trading at 50, 60, 70 times, depending on what you believe that 1 year forward earnings would be. What do you do with both of these?
Yeah, so the larger ones, and it's more a valuation call, of course, over a very long period, and you have seen several of these companies buying back their stocks. Probably they have a lot more confidence in terms of the long-term potential. Could also be that their asking rate of return is substantially lower than probably the domestic investors. So we are underweight that whole staples space, but there are like those niche players where we think that this is a new India. The aspiration levels of the young people, particularly in the rural side, is very different. Several companies are getting that benefit in terms of the new areas that are emerging within the consumption theme. So we are more in that space rather than the large cap staple space. We are underweight there and looking for those bottom up opportunities.
Okay, 2014, maybe 6 months or maybe the whole year, but there's an event, so I want to ask you to predict for the whole year. What do you think will do well?
So it'll depend probably that as you have the election outcome, though I would say that the markets are not very good in terms of looking at the longer term impact of an election outcome on the economy and the market. So in 2004, markets thought it was like an extremely disappointing result. I mean, and UPA coming with the left support, but the next 5 years turned out to be the greatest period ever in terms of the macroeconomy as well as the markets. 2009, I mean, after the election results, we were circuit up, so it was like a euphoric moment, but the next couple of years turned out to be very challenging. I don't know how would markets react after the May 2014.
Are you predicting if we do very well?
I'm saying that in case the outcome is in line with what the markets expect, I think it could be a euphoric reaction immediately after the election. To some extent, it may get maybe markets might start discounting it a little before the elections. And historically, we have seen in last 30 years that when you have that kind of an outcome, a lot of the gains of 2 or 3 years get front loaded in that particular year, because markets tend to discount things far in advance in case that outcomes come. Even otherwise, I mean, theoretically speaking, I think the earnings growth has completely bottomed out, and one can expect maybe going back to let's say a 15% or so earnings growth for next couple of years. And if the PE remains at the current level without taking any derating or any re-rating, I think a logical, I would say, expectation would be let's say 15% or so growth for the next year. Having said that, I mean, you don't get returns in the equity market in a very linear fashion. So maybe in case you have a better political environment, a lot of those 3 or 4 years of earnings growth probably will get discounted next year. If you get slightly disappointing results, then probably it may get a little back-ended. But next couple of years, I think that should be a reasonable expectation from the equity market.
So working with a base of 15%, what can outperform?
So maybe the laggards of last couple of years, that should be the space to watch out for. We talked about the benefit of the weaker currency for some of the sectors, but I think a good part of corporate India has restructured its operations. The downturn teaches you a lot. So during the boom period of 2005 to 2007 or 2003 to 2008, I think a lot of excesses got created. I think last couple of years, due to the way, I mean, the capital markets have also behaved, I think they have disciplined a lot of companies. People are now focusing a lot more on return ratios rather than the empire building, and I think you need to watch that whole space of, I mean, take the 20, 30, 40 large caps because they are fairly discovered because we've got so much of foreign flows. But look at the rest of the market. I think the whole investment universe probably can expand next year, and you need to look at those spaces where probably that restructuring has happened.
So what is it? Is it investment cycle picking up and therefore capital goods or infrastructure? Where do you find
I think so. I think that there are those kind of pockets where valuations are reasonable. Market is not looking at that space in last couple of years for the valid reasons, because earlier I think due to the policy issues and also the business decisions that were taken, I think probably they overextended themselves. Now as you get into a cyclical recovery, obviously a lot of those that particular space looks interesting. And also I think from next year onwards, the growth in our macroeconomy has to be driven by the revival of investment cycle, and I'm sure that policymakers will pursue a path where you can't again get a higher growth based on boosting the consumption driven by the fiscal side. So it has to be driven by the investment cycle. A lot of good decisions have taken place in last 1 year, but they are going to reflect, I mean, in terms of better macro in the next several years, and with a better government next year, I mean, with the new government in place next year, I'm sure that I think the investment cycle is something that one needs to watch closely.
Okay, and just very quickly, if indeed you believe that cyclicals might be a play over the next 12 months, would metals form a large portion of that, or would you just avoid that pack completely?
That's a bit tricky one, because in metals what happens that if you look at our individual companies, few are just converters. They don't get the benefit of, just in case the global metal prices go up. And our overall view for last couple of years has been that the commodity super cycle is behind us. Aluminium is at a multi-year low, and then you need to be a little cautious in that particular space. But again, I mean, in some of the cases valuations became far too, I would say, cheap, and every time that there is a cyclical recovery, and particularly from the global market perspective, there would be those tactical opportunities. But on a structural basis, if you have to take a 3-5 year call, I don't think that's a space where one would look at. I think the overall investment cycle, there are various other ways to place that through some of the asset owners and through some of the other providers.
Great. Navneet Munot, thanks so much for taking the time out and being with us on this leg of Market Makers. Thanks for being with us on the show. Well, that's the view from SBI MF. Fairly bullish on 2014, 15% base case scenario, and there are pockets which could outperform, obviously, but there would be some pockets which would underperform as well. Need to watch out for what happens in the elections is what Navneet Munot is saying. Thanks for watching this leg of Market Makers.